Today is Tuesday, the 3rd of February 2026. My name is Francisco Gaffney, and this is my daily streaming all about governance, risk, compliance, and advisory boards. Yesterday, we started the week with the intellectual property led growth because without an asset story, everything else becomes a fight for volume. Remember, we spoke about capacity and capability. But today is a second lever, which is capital structure. So in the boardrooms, I hear this line a lot. Operations are improving, but the numbers still don't look that good. Sometimes that is execution. Often it is a capital structure quietly fighting your strategy. So today, let's take a look at three things to consider when your capital structure battles with your strategy. Number one is the higher interest rates and tighter credit conditions change the tolerance for operational wobble. So when the cost of money rises, weak conversations and delayed programs get punished faster. Problem number two is that UK reporting expectations force the issue. What I'm saying is going concerned assessments and transparent reporting become critical when funding runways are tight and uncertainty rises. Problem number three, I'm going to use an example for this to illustrate the problem. It's coming from a live listed supplier in the London Stock Exchange I'm watching. They published a recap protocol including a capital increase with preferential subscription rights of about 100 million pounds, a 54 million pounds new loan, an 84 million pound debt waiver, and a reported completion of 125 million capital increase. So that is what strategy meets balance sheet looks like in public. In other words, let's imagine this: a growth strategy on the wrong capital structure. It's like, I don't know if you saw the Netflix documentary about this gentleman, Alex Honnold. He solo climbed the Taipei 101 building, is 508 meters tall. So if you can imagine that, how tall is 500 meters? It's like 167 houses, average houses stacked on top of each other, all the way up to 500 meters. Now, when I say that imagine growth strategy on a growing capital structure is like this, I mean that actually if you are solo climb a building that is like slippery because all the surface is glass and he used his fingers and feet to all the little cracks and structures, advantages, corners that can he use to help him climb the building in a very slippery surface. But let's try this. Just climb your own house with a ladder, but with the raw stack full of stones. Just you can imagine actually the vertigo. Just if you only climb your own house, don't go into the 508 meters tall building. Just go a house which is around 4 to 5 meters tall. With the ladder, it's already kind of a unsettling sensation. But if you do with the 20 to 30 kilos of stones on your back, that is when the growth strategy is depending on the wrong capital structure. I hope you get the picture, but actually I couldn't find another one. Sorry about that. But the mistake boards make is treating capital structure as a finance problem that you solve once and then move on. And that's where the raw stacks start to get heavy. In reality, capital structure is the operating system for the strategy. It's not the other way around. So it determines what you can invest in, when you can invest, and how much bad luck you can survive, because you have to consider that too. And there is a second, quieter problem, if you may. If management knows the runway is short, behavior changes. So they stop investing in the hard work that builds capability, and they start making decisions that create cash this quarter, even if they weaken the business next year, right? So it's all about survival mode. So what do you do as a board advice, as a board member, or a C-suite executive without turning every conversation in a spreadsheet war, right? Because actually now you have to all about the numbers, but actually you forget about all the things that you have to do. Now, As a board advisor, what I will propose to consider is the following in these cases. Number one, start with the wrong way, not the ratios. Build a board view of liquidity and headroom under three scenarios, which is the base, how you can stresses, and the customer's delays. And we are going to come to the customer's delays in the next in a moment. So that keeps decisions anchored in time, not in spreadsheets or prior ratios. Suggestion number two, know what you can actually pay out and what you can actually raise. And here's the thing, the UK capital maintenance and distributed profits guidance shapes dividends, buybacks, and capital allocations communications. So you already have a guidance there, so use it. And number three, treat your major funding moves as governance events, not quick fixes. So UK listed companies face shareholder expectations and disclosure requirements for certain significant events and transactions. So if you ignore mechanics, you lose time when time is the one thing you do not have. Now, let me bring this back to the reality of an international complex supply chain. And by the way, these international supply chains also face similar challenges or the same challenges that any other supply chain scenario. You can translate this however you like it to your own company, even if you are on the £1 million revenues or £5 million revenues. You have the same complexities and challenges that the big international supply chains. And here's the thing, if your customer pays on long cycles and your suppliers want cash now, the working capital becomes a hidden debt because what happens here? So what happens here is that you are funding, right? You are funding your suppliers and you are financing your customers. It's a very, very bad position to be in. If you have these long lead times, a single sleep becomes a cash event rather than a scheduled event. Yeah, so it's a big problem here. So if you have a debt with tight terms, a temporary margin dip becomes a strategic freeze because actually you have the terms. So that is why capital structure fights your strategy. It turns operational noise into existential problems and boardroom dramas. Yeah, existential problems means because you had to fight this situation rather than actually looking to growth and resilience. So a board level recap needs to do three things at once. The first thing they have to do is extend the runway so leadership can make decisions that take months, not days, right? The second thing is reset incentives so the organization stops prioritizing cosmetic wins over real capability. And third, protect investment that creates a durable advantage, even while you cut costs somewhere else. And I suggest three questions here. Number one, what is the business allowed to do under current funding terms? Question number two, what is the business forced to do if the downside case hits? And question number three, what will we do differently if we had 18 months of runway, not 6, right? So why does then a board level recap approach matter? For three things: outcomes, differentiators, and risk reductions. In terms of outcomes, you use the assets lens to link capital to capability. So you ring-fence this investment and create a durable advantage and stop funding work that only buys short-term survival, right? In terms of differentiator, you stress test the strategy against disclosures and shareholder mechanics. So the plan is executable within the UK governance reality, not just on the spreadsheets. And in terms of risk reduction, you build a board pack aligned to recognize UK guidance on ongoing concerns and capital constraints. So you reduce surprises when markets and auditors ask hard questions. You already follow a guidance that is recognized by the UK. Now, one action you can take today, and it's doable in 30 minutes or less, write down your next 3 strategic moves and note what each one needs in cash, runway, and not in optimisms or forecasts or wishes, like cash and runway. Now, So let's pause it here for today and reconvene tomorrow. Because yesterday, if you remember, I mentioned intellectual property led growth. Today, we looked at the capital structure fight in your strategy. And tomorrow, we are going to shift to the footprint resilience. So the resilience is a keyword here. Very interesting topic for tomorrow. So if you are a UK board member or finance leader or C-suite leader looking for a different view of your own company, set up a 30-minute call so I can understand your position and how an independent international advisory board looking from the outside in, right, from the outside into your company, help you and your team without stepping your toes, without a traditional consulting overhead, and without a public theater. Excellent. So let's have a great day and see you.